Hello and welcome. You're watching us here on Trading Hour. We come to you live from the CNBC-TV18 Motilal Oswal studio. I'm Mangalam Malu. With me, Hormas Vatakia. And also, as always, we have Ritu Singh joining us as well. Good morning, Ritu. Happy Monday, if there was something like that. That's something that bulls won't be happy with. After 5 days of selling, the market continues to reel under pressure and there's no respite. The only hope that the street has now is that 25,500 holds, because the shorts have been at an extreme and the mid-cap index continues to sell. The Nifty Bank's seen some recovery, but no respite whatsoever.
No respite, Mangalam, and I was hoping your FNO cues later will give us some sense of whether, these 6 straight days of losses that we've seen will see some reversal, later as positions build up. But yes, we're starting the week at sort of the midpoint of that trading range we've seen the Nifty hover around in the last month or so, and that's 25,700 to 26,300. That's sort of a range, and it's now trading at about 25,550. So, that's where the Nifty is at. If it, crosses that 25,600 level and makes an up move from there, that's something we'll keep an eye out on. But it is earnings season. There's going to be a lot of stock-specific focus. IT sector kicks it off with TCS and HCL Tech today. And of course, as always, Nifty Bank, like you said, I think 59,000, that's the key downside to watch out for. Currently trading in the red as well. But Hormas, as always, is standing by to put a spotlight on some of the top movers in the market today as we start the week. Hormas.
Well, if only we could have called this a Super 6. Of course, it is a Super 6 for the bears for sure. It's a 6th straight day of losses coming in for the index. But surprisingly, in a market like this, today's list comprises of 2 stocks that are gaining, that are bucking the trend. One such name that's bucking the trend is Linde India. And that too has come off slightly from the highs of the day. At one point was up 6.5%, now up 4%. At the intraday high, it was the biggest single day gain since May. Was the second best performer on the Nifty 500. Volumes were the highest in over a month as well. They had close to 90,000 shares traded on Linde India today. The 20-day average is just 4,000 shares. So significantly higher compared to its 20-day average. The stock took support at its 50 DMA and then moved above its 100 DMA on an intraday basis. And now the 200 DMA on the upside comes up to levels of 63.84. So it's still some distance away from here. And when it entered 2026, Linde India was coming on the back of 7 consecutive months of losses. The theme that has been the talking point over the last couple of days has been the capital goods names, and it's so evident in the price action as well. Hitachi Energy down 6, BHEL 5, GE Vernova 5, and the lot of other capital goods names also trading with losses of around 3 to 5% as well. If you take a look at the volumes of barring GE Vernova, both Hitachi Energy and BHEL are declining on significantly high volumes. BHEL has had over 2.5 crore shares that have been traded. The 20-day average is just under 35 lakh shares, so it's almost around 6x of its 20-day average even in today's session compared to the fall that was seen last week as well in a lot of these names. And the last name on this list is BSE, another one that's bucking the trend today. That too is slightly off the day's high. At one point was up 4.5, now holding on to gains of around 2 3/4, bucking the trend in an otherwise weak market. We've had close to 30 lakh shares that have been traded on BSE. The 20-day average is around 13 lakh shares. The stock has moved above its 50 DMA, which is at 27.20. It's still holding on above the 50-day moving average, so that level becomes the key, and as a result of which it is now above all of its key moving averages as well. And in 2025, when the stock did very well, it turned out to be the 3rd straight year of positive returns for BSE.
All right. That's about all the buzzing stocks. But Horma started with all the capital goods stocks which are under pressure, that continue to be under pressure for the 3rd straight trading session. Vinny joins in to give us an overview of what's plaguing the space and why exactly are these stocks lower despite the companies having a commentary which is a lot more benign than what the street would have feared.
Hi, yes, thanks so much for that. Right, like you mentioned, right, 3rd consecutive day of sharp fall that we're seeing coming in for these capital good industrial players. When did it start? When we saw some reports that came in from Reuters. They suggested that there's a high-level government committee recommendation that has come in that the finance ministry is planning to scrap the 5-year-old restriction that was there on Chinese firms, maybe to start to participate in those government contracts for sectors maybe like power, railway and other sensitive contracts. And this had come into place. The restriction was there since 2020. So maybe if they lift these restrictions, that would mean some concerns coming in for some of these players, whether you look at an L&T, BHEL, which are into boiler turbine generators, Hitachi Energy, GE, Vernova, TNT, Siemens Energy, some of the names like CG Power, they are in power sector. So if this contract or, restrictions on Chinese firms to participate in the contract is lifted, then the street was worried that maybe this would come in as a concern for Indian players. Now, obviously, we had IFL's Renu Baid also who spoke to us today. And what she suggested that, seems like the street is not, or the channel checks are suggesting that only TBEA, which is a Chinese firm, they are allowed to participate as of now in some power grid tenders for reactors. It's not a blanket rule that all Chinese firms will be allowed to participate. This is the clarification or an understanding that even the analysts or channel checks are suggesting, and a no bulk import is likely to come in from China. So that is not a worry. But the street doesn't seem to be too happy with this situation as of now. We even had, according to CNBC sources, CNBC-TV18 sources, we picked up that, maybe as of now, no decision is made as such on this front as well. But the stocks continue to be under pressure. And just highlighting some of the reports that came in last week as well. Jeffries too had highlighted that, yes, highest impact would come in maybe to a BHEL, L&T, Afcons, ABB, CG Power. Lowest impact would be for defense companies. They don't need to worry much. While T&D companies could see some bit of an impact. So Hitachi Energy, that continues to be under pressure, severe pressure today as well. And even for Siemens Energy, we're seeing sharp pressures. Bernstein too highlighted that according to channel checks, relaxation is only in some form is likely, not a blanket rule. So that is the clarification that has come in. But let's keep an eye out on what the street is watching out for. Clearly, last 3 trading sessions, no one is accepting these clarifications or what analysts have been saying as of now.
Not good going for all of these capital goods names. Vinny, thank you for that update there. Continuing to extend losses. And speaking of those names, another name that comes to mind is Cummins India. That too has now slumped to the lows of the day, 4% lower on that stock as well. And the others, transformers and rectifiers, Hitachi Energy, CG Power, all of them not having a very good session. What's also not having a very good session today is delivery, and that has also now moved to the lows of the day, over 4% lower on the stock now. And with that move, the stock is now down 20% from its issue price, which is exactly 100 rupees above where it currently trades as 487. So 4.5% lower on delivery as well at the lowest point of the day. But speaking of such new age companies, there have been initiations that have come from brokerages on both Meesho and Grow in today's session. And Sudarshan is here to put the spotlight on both of these names. Sudarshan.
So first one is Meesho, where BofA Securities has initiated coverage with a neutral call and target here is 190 per share. It says that company is well placed to target value-focused mass market segment, and FY26 to 29 net merchandise value CAGR is seen at 26%. As far as adjusted EBITDA margin is concerned, in FY26, company had reported that margin of -3%. BofA Securities believes it can grow and it can increase to +3% by FY29. Also, at current levels, valuation is factoring strong fundamentals and tailwinds are room to gain market share, fintech scale-up and grocery expansion that company might undertake. Next one is Grow, where Kotak Institutional Equities has initiated coverage with a buy call and target here also is 190 per share. Some of the tailwinds that Kotak has mentioned, first one, durable product-led growth flywheel. Second, expanding monetization across broking, margin lending, wealth and consumer credit. And last one is scalable in-house technology. So 2 positive brokerage notes. First one, Grow, it's trading with gains while Meesho is under pressure.
Sudarshan, thanks very much for taking us through those. We have to slip into a short break though. Up next, we're going to focus on the bond market with Manisha Gupta, so stay tuned.
Presents Bond Street.
145 points lower on the index as we speak. DMart has now moved into the red after the initial surge that it had seen after its earnings performance. What has also moved into the red is Tata Communications. That has also seen a sharp surge, as a sharp downtick from the intraday high, so 2.5% lower on Tata Communications as well. But as promised, shifting focus to the bond markets, Manisha is here with the latest on that. Manisha.
Well, thank you for that. In the bond street today, we are talking about the overall market sentiment. And if you look at the government bonds, well, they are trading slightly on a firmer note. And this is on the back of the RBI's 500 billion OMO that the market has been talking about all of last week, by the way. Apart from that, it also has to do with the lower than indicated state bond supply. We do understand that 11 states are aiming to raise 268 billion rupees right now. This is versus the 361.9 billion. This was indicated in the calendar. So slightly smaller amount in sense of issuance is also led to some support in sense of markets there. That's about the government bonds, but the private really seems to be buzzing in the last many days and sessions now. So what we're talking about right now is PFC. They are looking to raise 50 billion rupees via the first tranche of public issuance of their NCD there. Interestingly, this is the first tranche rather, and the issue was opened on Friday. It's expected to close on 30th of January. This actually is the largest retail issue of bonds in nearly 8 years, if it gets totally subscribed, that is, and that's what markets are aiming at. Well, PFC will sell bonds maturing for 5 years, 10 years, 10 years and 1 month, and then 15 years as well. And we've seen support come in because of that as well. The NCDs will offer yields anywhere ranging between 6.8 to 7.3. 7.3, the highest, which is actually for 15 years there. This is payable per annum. This is across multiple tenors there. And markets are looking at this one with a lot of hope and excitement therein. Interestingly, it also is a statement that came in from SEBI chief in one of those events that he was attending, saying that they're examining trading in bond derivatives to deepen the corporate bond market. Well, remember, not too long back, Niti Aayog also came out with a very strong report suggesting a 7-fold way of going forward when it comes to corporate bonds. And that's what the SEBI chief also seems to be talking about in sense of bond derivatives to deepen those markets there. The other thing that the street will watch out for is the India CPI inflation data. Well, that comes in at 4 p.m. today. So ahead of that, that's something else also that the markets are factoring in sense of rupee and bonds, both of those markets. But with that, we'll go for a short break. When we return, we'll talk market technicals with Siddharth Mangla on the other side.
CNBC-TV18 and India Bonds presents Bond Street.
Welcome back. You're watching Trading Hour, and the markets continue to tread lower as we speak. The Nifty down 170 points and the Sensex trading with cuts of about 580 points. Let's go across to Mangalam for more cues on what we can pick up from the F&O space. Mangalam?
Well, there is no respite for bulls. We've been talking about that. And as we speak, even in the first half of trade so far, at any point, if one went short, they would be making money. This after the market having seen a big gash over the last 5 days. So the Nifty Bank, the mid-cap index, all of them are at the low point of trade. And any data point that you look at is telling you that there is weakness. NSE declines. Now, 2,400 stocks are in the red for just about 500 stocks which are in the green. That line would look like parallel lines and now has widened, with the red one being much above the green one. There's also, it's come along with the India VIX, which has seen a big spike too. Typically, when the India VIX spikes, the market falls. There is an element of fear which is underway. Two-wheeler players, the ones which actually did very well all of last year, they're coming in for some sell-off too. So Hero MotoCorp, Eicher, TVS, Bajaj, the ones you look at, all of them at the low point of trade as well. We're seeing some stocks buck the trend, but they've not been big movers on either side. So Coal India has done well, yes. IEX has been fairly volatile, continues to see some buying after the decline that we saw on Friday, and NTPC is mildly in the green as well. Rally continues for Hindustan Copper and Hindustan Zinc. These stocks are in a story of their own right now, and those stocks are at the higher end of range. But even if you look at all the other data points that tell you that the points are moving towards an extreme, there is still no respite. The FI is there 7.5% long. This was 13% at the start of the last week, which is anyway lower. The FIs increased their short positions and they're still making money on them. So no case for immediate short covering. Typically, the market bottoms out at these panic levels, but the panic continues. The Nifty now down about 850, 860 points from its highs in just the last 6 sessions. If you look at the call selling, call sellers are active at 25,600, 25,700. Now, as we speak, increasingly 25,500 as well. So all these levels are crucial as bears are coming in and putting their stronghold at these levels. put sellers at 25,550 were fairly active today. Now let's see whether they are unwinding their positions or not. And the 25,500 put writers, there is a fair amount of open interest. The Nifty on the verge of breaking that 25,500 mark. If it breaks below that and sustains around that 25,450 to 25,550, these put writers would be caught on the wrong side, and that would accelerate the selling for our frontline index. The put call ratio is at 0.7, again at the lower end of the range. But then when there is panic, there are no levels which are respected. A lot of shorts added on Hitachi and BHEL after these stocks having seen a big correction in the last two tradings itself and selling off for the third trading session. And there is still a fair amount of short build-up. So the ammunition for the bears is a lot more than the ammunition for the bulls. The only thing that one needs to watch out for is whether the market stops falling, and then only we can look at any sort of reversal and short covering. The key point right now, the market should stop falling.
That is the key point, but as of now, it does not look like that, because the Nifty is now down to the lows of the day. 25,505 is the new low that the index has now made. So now looking to defend that all-important 25,500 mark, 504 now being the latest low for the index. Siddharth Rai Mangla from Stockbox Technologies is now joining in for a quick chart check. Siddharth, good morning. Thank you for joining in. It doesn't look a very pretty screen as of now. How important is 25,500, and if we go below that, what are the levels you're watching out for on the index and your stock recommendations for the morning?
Hi, Hormoz. Good morning, and thank you for having me on the show, first of all. See, again, 25,500 is very crucial, and now we can clearly see that there is a lot of panic on the street among the traders right now, at least also because this uncertainty of big heavyweight results have also added into the existing geopolitical uncertainty, which the index was already facing. So now 25,500 will be very, very important. In fact, today's closing is going to be very important for the index, and that will be setting the undertone for this remaining week. So if Nifty goes below 25,500 and spends some time there, the next important levels will be straight in the 25,250, 25,200 range. So a closing above 25,500 is very crucial, not for a rebound or a bounce back in the index, just in order to pause this very sharp fall, which will eventually, if Nifty spends some time above 25,500 and manages to close above 25,500 today, it will definitely be giving some confidence to the bulls. So today's closing is going to be very, very important for the index.
Today's closing will be very important for the index, but in a market which is falling like this, would it be more prudent to take short positions or long positions?
Yeah, hi, Mangalam. See, it'll be better to keep a balanced approach in a market like this. So I have two stocks. One of them we have to buy and the other one we have to sell. The first one which we have to buy is HDFC Life. See, the stock has a very important base around 750, 745, these levels. And we are seeing some, attempt of a bounce back in today's session as well. So HDFC Life can be bought if there is some recovery, any case of a recovery in the index. The stock will be, going up, moving up very sharply. HDFC Life can be bought right now. The spot is around 755-ish. We can buy it here. The stop loss will be at 745, and our targets being the first target 775 and the second target 785. The second stock, and this one we have to go short. This name is Tata Power. This whole space is kind of looking weak, and there was a very important base for this counter around 370 levels, and which this stock has broken yesterday, and today it has not fallen much, but I definitely think that this fall can definitely extend from here. So Tata Power Jan futures, we can go short. Right now the Jan futures are trading around 364, 365-ish. We'll go short. Our stop loss will be 375, and the targets being the first target 340, second target 335.
All right. Thanks a lot, Siddharth, for joining in. And just as we speak, the Nifty has broken the 100-day moving average of 25,540, closing in at 25,500 mark. So closing above that will be very crucial, as Siddharth pointed out, because now the next technical support will be 200 DMA, which is a little over that 25,000 level itself. So 25,500, the market holding that level by the skin of its teeth. Take a short break, come back. We'll discuss the market fundamentals with Manish Jain, who's the head fund management from Centrum PMS.
still fighting to hold that 25,500 mark on the index. So 180 points lower now as we speak. 25,502 and counting is where the Nifty currently lies as the selling pressure continues to mount on the index. Well, one stock that had opened higher but now has given up all of those gains is DMart. The numbers were okay, there's an EBITDA surprise, Mangalam, but what's playing the stock now?
Valuations. That's the one thing that always plagues DMart. But for what it's worth, the EBITDA was definitely a positive because, especially coming after a 13% revenue growth, which the street was slightly disappointed by. We had an inkling that maybe it's because of lower realizations because of the GST cuts that were announced in September. So that would obviously lower the basket size of a purchase. Basis that, the analysts were expecting 8 to 10% EBITDA growth. The company has gone ahead and reported a 20% revenue growth. In fact, EBITDA growth rather. The margins also, as against expectations of a compression, have improved, and that was led by gross margin improvement. Now, there are two factors that explain the gross margin improvement. One would be lower discounts because the prices were anyway lower, and the second part is increasing share of revenue coming in from the personal or private label products, which typically tend to have slightly higher gross margins in the FMCG and staples categories. There was no major change in the product revenue mix for the company this time around. And the management confirmed that the revenue growth was partially impacted by deflation in staples. So overall, on a consolidated basis, 13% revenue growth, gross margins improving 60 basis points, EBITDA jumping 20%, and margins coming in at 8.1% as against expectations of a compression. The net profit increasing by 18% as well. Like-for-like growth in the third quarter was up around 5.6%, and sales per square foot was marginally lower, but nothing which is worth complaining this time around. The only problem, DMart trading at around 90 times 1 year forward earnings, and at the same time, it's never been cheap. Growth is picking up. The street would have liked a little more than just this marginal expansion in margins. This morning we had Abnish, the analyst at Nuvama, join us as well. He said for a significant re-rating, you have to see revenues growing between 18 to 20% as against just 13 to 15% that the company has been reporting. So that's about Avenue Supermarts. Opened fairly well, and now with the market has seen a bit of a decline. And as we speak, just don't lose sight of the Nifty. It's broken the 25,500 mark. It's the same stocks which have been dragging it lower, which are seeing extended cuts. The Nifty Bank is lower. We have a big decline that we've seen in a couple of these metal pack. Nifty IT, that index as well comes up for you currently at the low point of trade ahead of TCS's earnings. And ITC, that stock too, pressurizing the frontline index, now below that 25,500 mark. Let's see whether it sustains here or not, because if it does not, then all those 25,500 put writers will be caught on the wrong side and will have to panic mode, unwind those positions. Perfect time to actually then get in Manish Jain, who's the head fund management at Centrum. Manish, thank you so much for joining in. There is a serious, experience of panic on the streets right now, especially over the last 6 or 7 days, where the Nifty has fallen about 900 points from the peak. And a lot of the broader markets are a lot more lower. In this situation, are you finding any opportunities for purchase, or is it still you're awaiting a decline further to stabilized levels for you to go ahead and start purchasing?
I think what the investors need to realize is that this volatility which has set in the last 5, 6, 7 days was a little unexpected. You expected with the advent of the Q3 results and the outlook being as good as it is, we are expecting a pickup in earnings, probably even a surprise in the quarter 3 as far as earnings versus actual delivery is concerned. The markets would have been far more stable than what they are right now. But I think it's got more to do with the global geopolitical situations than the factors here in India. Of course, there's one, which is the tariff bill, which has been proposed in the US, which takes the duties to about 500%. That should be a big cause of concern for India, effectively putting the entire US merchandise export basket in a jeopardy. And then the whole Venezuelan situation, right, that kind of continues to remain in a little bit of a flux. You don't know where it goes from here. So the problem with the market really for the last 4 or 5 years or has been that the domestic liquidity and the domestic economy continues to remain absolutely stable, absolutely strong. We've seen that in the real GDP growth rate numbers. We've seen that in the earnings growth everywhere. Whatever has been happening on the global front. And whenever you feel that it's about to end is when the new chapter again starts and something else or the other happens over there. So I think what the investors should do at this moment is not to wait for a further correction, because see, you can never really time the market to perfection. It's not going to be possible. And if you are a 2, maybe 3 year long horizon investor, then I think you identify sectors where you are materially looking at an earnings pickup to happen, where the environmental factors to the domestic economy are conducive to it, and start building up positions over there. So I would be buying banks, I would be buying autos, maybe even IT at this juncture doesn't look all that bad.
Okay, autos and IT is the two sectors you're picking, Manish. But like you said, the geopolitical stress, it continues to remain center stage from Venezuela to Iran. I mean, the focus keeps shifting. But domestically, what are the cues that you'd watch out for? And also, some of the themes like the capital goods space. These reports, although unconfirmed so far, on curbs being eased on Chinese goods. How do you expect that space to get impacted?
Yeah, so that has, again, already started reacting a little bit, right? I mean, you've seen that across different stocks in the last 1 week or so, that there has been a little bit of correction over there. But specifically speaking, as far as domestic markets are concerned, I think there are a couple of things that I would look out for. See, one is that, of course, that rate cut cycle, at least the way I believe it is far and behind us now. It's going to be more of a stable rate regime. So that expectation is completely out of the way. Rupee becomes an important factor in play over here. It should kind of stabilize at these levels where it is today. And the third and the most important factor, which is going to drive the market henceforth, is going to be the earnings growth. See, for the last 4 odd quarters, right, starting from September, October of 2024, the market has been in a little bit of a pressure, largely because earnings have been getting cut every quarter after quarter, right? So we've been expecting 12%, delivering 6-7% or thereabouts. This is a first quarter where, because of the GST rate cut, the pivot happens. We've seen the provisional numbers come from banks, and they have been very, very good across the board, right? Everybody's been reporting significantly higher numbers on a sequential basis. So I think this is where the sign is, and I would watch out very closely for the third quarter results to actually start taking positions across different sectors. And then, of course, the most important thing is to watch out for budget next month.
We'll watch out for the budget. Of course, we'll keep an eye out on that. But Manish, since you mentioned earnings, we start off with them in full earnest from today. From the IT space, you have the big names, TCS, HCL Tech, almost all of large cap IT reporting this time around. What are you anticipating from these companies? There has been no particular change in demand from the on-ground scenario, as you heard from earnings of Accenture as well. So what do you expect from these large cap IT, and do you expect mid cap IT to outperform this time as well?
No, I would be a little more bullish on large cap IT as compared to mid cap IT. And really, I think my bullishness on IT stems from one factor, which is that it's going to be a good sector rotation play. And that's something that we've seen on and off. This is one sector that has been neglected, and quite rightfully so, for some time now. We've seen guidance getting cut. We've seen multiples getting cut. And I feel from a valuation as well as earnings expectation standpoint, this is very optimally poised at this juncture, where there are no real negative surprises at play over here. But if you have the patience for 1 year, I think this can be a good dark horse. That's where the bullishness stems in from.
All right, Manish, thanks a lot for that short but effective conversation out here. But panic continues in the market. The Nifty now at 25,485. We've seen a big cut come by in a couple of these PSUs also now. BEL for one, which was marginally in the green at the start of trade, has now moved into the red. In fact, it'll make more sense to pull up the advanced decline once again, or maybe one of the broader indices heat map, because when we started the show, we had about 2,100 stocks which were in the red, and now that number's swiftly moved to around 2,500 with just 400 stocks which are in the green right now. Power Grid, look at that one too, was marginally in the green and now has moved into the red. Devi's Labs continues to be under pressure. The two-wheeler space also continues to be under pressure. Some of these new age names as well. Eternal for one is currently at the low point. So across the board, there is selling. Where does it go from here? We'll probably keep a tab on that after this short break. Stay tuned. There you have it, the Nifty heat map, way more red than green.
Welcome back to Trading Hour, and it's time for the macro signal of the day. Let's start with the markets as always. It's been the sixth straight session of declines. The market's now at, near low points or new lows that we're seeing at the moment, trading with cuts of 201 points. The bank Nifty also mirroring that sentiment now, trading with cuts of 351 points at 58,889. The mid-cap and the small-cap index also in the red. Let's quickly also pull up the rupee, which is trading with caution because of what's happening on the oil prices on one front, and of course the continued pressure from FII selling, now at about 90.17 as we speak. In the 10-year GSEC, some interesting moves there in the money market. The 10-year actually opened at 6.60, but then it quickly dropped by about 14 basis points because to about 6.50%, and that's because traders say there was some erroneous trade, a fat finger error, so to speak. That was corrected, and now, it's trading firm at about 6.63. The RBI OMO is very much in focus on that front. Crude prices, meanwhile, continuing to react to the geopolitical tensions, whether that was Venezuela oversupply concerns earlier and now the stress across Iran. But let's delve deeper into the US President Trump's 10% proposed credit card interest rate cap, what it means, who it hurts, and who it helps. Now, keep in mind, millions of Americans rely on credit card to manage their everyday expenses, and for many, that comes with a very steep interest rate, often more than 20%. Now, Donald Trump has proposed capping this rate at 10% for 1 year. Of course, it's still a proposal at this stage. Any nationwide cap will also require the Congress to pass legislation. Now, credit cards, if you look at them, are deeply embedded in the American financial system. In fact, data shows 74% of all adults in America have at least one credit card. There are more than 360 million active accounts nationwide, and the average person holds at least 3 to 4 cards on average. Now, Americans owe more debt than ever before as well. The current debt at $1.2 trillion for credit card dues. Just in 2024 alone, they paid roughly $160 billion in interest. So for people who are carrying balances, that is not clearing their entire credit card bills every month, a 10% cap could meaningfully reduce the interest cost by tens of billions of dollars. Now, here's how the math adds up for banks, though, if this is implemented. Now, if you look at the Federal Reserve data, the average U.S. credit card annual percentage rate, or APR as they call it, is above 22%, and the average revolving balance that is, on the credit card is about $5,500 to $6,000. At 22% APR, the banks will earn about $13, $20 a year in interest from a customer. And with a 10% cap, that will drastically drop to $600, which is a loss of $720 per customer, or more than half of the interest income just foregone. Now, scale that up because a large card issuer, with 10 million revolving customers, for instance, could see interest income fall by roughly $7 billion a year. Now, could something like this happen in India? That's the question everyone's been asking. There's been opposition in the US, but in India, lenders typically charge you as high as 36 to 48% annually on credit cards, depending on the issuer. Now, while RBI can influence pricing indirectly, imposing a flat 10% cap at the moment is out of the question, because it would be unprecedented and almost certainly require legislative backing and wider consultation with bankers, and it is sure to see a pushback. So that's as far as the macro signal of the day is concerned. But let's continue with that theme, because the latest CRISIL report highlights how India's banking cycle is evolving. System credit growth is holding up at more than 12%, but deposits have been pointing out are lagging at 9.4%. The loan-to-deposit ratio, which we pointed out, is now at an all-time high. That gap explains why banks are becoming more selective, and the mix of lending is clearly shifting towards the secured part. To discuss that and more, we have Krishnan Sitaraman, the Chief Ratings Officer at CRISIL Ratings, joining us. Krishnan, thanks very much for your time here. From the third quarter updates we've got from banks so far, what was your biggest takeaway in the shift towards secured? Is this a temporary phenomena, given the kind of stress we've seen in that segment, or the RBI action, or is there a structural shift that you're seeing take place?
Hey, good morning, everyone. Thanks for having me on the show. I think in the banking sector, I'd like to preface it by putting the fact that if I look at the balance sheets of banks today, they are perhaps at the strongest that I've seen in the last 15 years or so. If you look at metrics like gross non-performing assets, provisioning coverage ratios, capital adequacy ratios, as well as the liquidity coverage ratios, all of them are at a very healthy situation. So overall, banking sector balance sheets look healthy. Coming specifically to your questions in terms of the Q3 numbers, or in fact Q2, not all the banks have disclosed the Q3 results as yet. what we are seeing is an increase in the loan-to-deposit ratio. That's something that we are seeing, and we are seeing credit growth picking up. And we believe the reason for that, the LDR or the loan-to-deposit ratio going up, is that deposit growth is lagging credit growth. And that is a key monitorable for the banking system so far. Because if I look at the last quarter or so, credit growth has shown a meaningful pickup. And that is benefiting from the steps which are taken by both the regulator and the government in terms of aspects like GST rationalization, the income tax cuts, lower interest rates, and benign inflation. All of that is resulting in consumption demand picking up and translating into retail credit growth picking up. And also we are seeing MSME credit growth holding strong. So that is supporting credit growth, which at the end of November was 11.5%. In December, it has moved up to 12%. But deposit growth is lagging.
Yeah.
Let me take you back to the beginning of, say, FY24. That was a time when deposit growth lagged behind credit growth by around 500 basis points. From then on till Q1 of this fiscal, that is June of this fiscal, we have seen deposit growth catch up with credit growth and for a brief period even exceed credit growth. But that was when credit growth was anemic in the first quarter. But then credit growth has picked up, and we are seeing a deposit growth lagging. That difference is picking up. So that has resulted in a difference of more than 200 basis points between deposit growth and credit growth. And that is resulting in an increase in the LDR ratio levels. And while credit growth is, the demand is there because our economy is growing well, but banks will be cautious about the rising LDR ratio, and they would want to keep it within specific limits. And one of the ways in which they can do it is look at securitization transactions. Last fiscal, we had one large private bank looking at that. So I think that is a key monitorable, deposit growth and how that pans out. Otherwise, balance sheets look good. Credit growth, there is a good uptick in credit growth demand.
Got that. Krishnan, balance sheets look good. Bad loans are at decadal lows. But my question is, one of the standout trends has been this spurt in MSME lending. Now at almost 32.5% of the incremental credit. My question is, what is the risk, given the tariff, threat looming large still? And what is the kind of provisions that banks have already made, and which ones are more exposed?
Sure, I think the sector in terms of NPAs that we are monitoring is the MSME sector, because overall when the cycle turns and asset quality starts deteriorating, it is the MSME sector typically which gets impacted first because their financial resilience is relatively weaker as compared to large corporates. So while we are seeing an increased demand from MSMEs, and that is because of the overall improvement in the economy, there are certain pockets in the MSME sector which are facing headwinds, and those are sectors which are more export-oriented, which have an exposure to the US sectors like gems and jewelry, we have home textiles, we have the marine food segment. So some of these sectors are having a higher exposure to the US and the tariff scenario. And where we are cautiously monitoring the situation, there could be chance of NPAs going up. But if I look at the MSME sector as a whole, our projection of NPAs as of this current fiscal end is around 3.9%, which will be around 20 to 30 basis points higher over the course of the fiscal. So it is not a very sharp increase in NPA we are expecting, but some increase in NPA in certain pockets and sectors we are expecting. The other aspect
Krishnan, we've taken note of that. Yeah, we've taken note of that. Unfortunately, we have to get back to the markets. That's all the time we had. Thanks very much, Krishnan. MSME as a sector to keep an eye out on when it comes to stress for banks. That's a good takeaway for us to end this on. We'll slip into a short break. We thank you, Krishnan, for your time. We'll get back with more on the markets in just a bit.
Market continues to reel under pressure. Now 200 points lower for the frontline index, and the mid-caps have it even worse. 2,500 stocks which are in the red. Titagar Wagons, that's the one that comes up for, on the sellers list right now, currently at the low point. Delivery, which continue to see some fresh shorts, continues to see addition on the short side, extension of those losses. And Loris Labs, one of the big stars of 2025, now starting 2026 on the back foot with a cut of almost 6%. Just watch out for the 25,500 put, because the Nifty has broken that 25,500 mark. The 25,500 put still has 2 crore shares outstanding. The premium has spiked from 50 rupees to 72 rupees. So those writers will suddenly start feeling the heat. If the market sustains here, these guys will have to cover their positions. That will cause an accelerated decline. Hormaz.
Yeah, the top 3 losers on the mid-cap index now are capital goods names, as we will be highlighting all through the show as well. BHEL, Hitachi, Cummins, all of them now trading with losses of anywhere between 5 to 6%. Paytm has now moved to the lows of the day as well, 3% lower on that stock. And of course, Tejas Networks, the earnings accident of the day, 11.5% lower now as we speak. So not good going for Tejas Networks as well. So not a pretty picture if you are a bull, Ritu.
Not at all. And in fact, it's the heavyweights that are dragging the Nifty down, from Reliance and HDFC. These are the big draggers. If we pull up the chart, L&T, M&M, Infosys are the other big draggers that are, sort of taking the markets down. And on the upside, there's some support coming in from ICICI Bank, Coal India, and then the likes of Trent, SBI Life, etc. But not a good day for the markets as we end trading hour. Thanks very much for tuning in. From Hormaz, Mangalam and me, it's a goodbye. But Halftime Report is going to take all the action forward, so stay tuned.